Hey, what's up? I'm Russ, and this is Dapper Dividends. Thank you for making me part of your investing journey. And here on the channel, as always, we talk about dividend stock news, ideas, and analysis. Hey, do you know which company feeds 1% of the world's population every single day? Now, if you are a regular here on the channel, you absolutely know the answer. And we're going to have that for you at the end of the video, so stick around because we're talking about dividends that might be on sale. And these are companies that recently hit a 52-week low, and they pay an over 3% dividend yield. So we're going to take a peek at these three companies, and we're going to see if there's something that I would invest in. When I was in the Navy and we would go out to sea, we would always be bittersweet, and we would say haze gray and underway, because all the Navy ships are painted haze gray, and now you have some more useless information. But if you love dividend growth investing as much as I do, please gently tap the like button and let's get it on. Here we go. First one is Amgen, ticker AMGN. Amgen is one of the world's largest independent biotechnology companies, and they have a market cap of $118.65 billion, 52-week high, $276.69, and a 52-week low they just hit of $207.65, and year-to-date, Amgen is down 7.81%. Now, I love going through financial statements, so I've kind of come up with a little bit easier way for most of you to see this. I've pulled out important numbers, and instead of showing you and doing the little blue box, I just pulled some numbers and did it by percentages, whether they increased or decreased from 2016 until 2020. So Amgen's revenue from 2016 to 2020 has increased 10%, which is good. Could be a little bit better, but it's good that it's positive. Their net earnings, not so good, down 25% in 5 years. That is not good. The retained earnings, another black eye from what I'm seeing here. Their retained earnings, negative 4,787%. That is really bad. So remember that the market in the long run is always a weighing machine, and companies that are looking risky, companies that are looking risky and rocky are going to be reflected in their share price because people are going to bid that down. Their long-term debt has increased 8.95%. Now, the interest coverage ratio, this is how much operating income do they have to pay every $1 of interest expense. Currently, $7.52 of operating income to pay every $1 of interest expense. So that's not too bad. We really like to see a number over 5 because it gives them wiggle room in case they hit any headwinds or cyclicality that knocks down some of their earnings. The stockholders' equity has decreased almost 70% in 5 years. That is something that you need to be aware of if you're considering investing in Amgen. So we love dividend increases and share buybacks. And in the last 5 years, shares have decreased by 21%. Their earnings per share over the last 5 years has increased 20%. So that's really strong. Dividends increased almost 12% in those 5 years. Now, their current dividend free cash flow payout ratio, I like to use free cash flow payout ratio instead of earnings per share because earnings per share is a number that can be financially manipulated by accountants, but the cash flow is much harder to mess around with. So their current dividend free cash flow payout ratio is 38%, which is very, very low. And their free cash flow per share in the last 5 years has grown almost 20%. Currently has a 3.37% dividend yield, paying out $7.04 annually. That payout ratio, they use earnings per share, is 42.95%, but you know it's actually lower than that. 5-year growth rate, 12.67%, and they've been growing that dividend for almost 10 years, and they do pay that out quarterly, $1.76. During my research, they have some cholesterol and migraine drugs that have been added to their pipeline, which was kind of lagging. And on top of improved manufacturing, these are things that are going to be tailwinds for Amgen going forward. And here in the United States, biosimilars have really put pressure on Amgen, and they lack focus in large markets like osteoporosis and cardiology. So when I saw this pop up on the radar, I thought this might be a good stock to buy because they've been increasing that dividend for almost 9 years. But man, that retained earnings that's down almost 5,000%, that really hurts. And the negative net income, it's a deal breaker. I would just rather put my money into Johnson & Johnson because they're so strong. And again, when we buy stocks, we want to buy them for the long run. But Amgen makes me nervous, and I don't like being nervous when I'm buying for that passive income. So I can sustain and I can stomach a share price that's down for a while, but I think there's a good reason that Amgen is dropping, and I'm going to stay away from Amgen. Next up is Pinnacle West Capital Corporation, ticker PNW. They are an Arizona utility company, and their stock is a 52-week high of $91.88, 52-week low of $65.94, which they just hit. And they have a market cap of $7.51 billion. And they are down almost 16% year to date. Let's see if we can see why. Oh, come on. My 19-year-old cat just took a dump on the floor, so hooray! Okay, Pinnacle West, here we go. Revenue is only up 2.79%. Not good at all. Net earnings, though, is up 24.5% over the last 5 years. So I like that. That's solid. Retained earnings, that is up. That's good. The retained earnings, you love to see that because that's just more money that they can put into the company and help grow the company and help them move and shake and bake, baby. The long-term debt, I don't like this at all, but as a utility company, a lot of them have high capital expenses, high operating costs. So long-term debt is up 57% over the last 5 years. And I really don't like to see debt increasing that much that quickly. The interest coverage ratio, remember, that's how many dollars they have of operating income to pay every dollar of interest expense. Only $3.52. That's below 5. That makes me nervous. I don't like that. Stockholders' equity, not world beating, but they have increased shareholder equity almost 16.5%. They have diluted shareholders just a little bit, 0.80%, so not really bad. You don't want to see companies issuing too many shares unless they're using it to really ramp up growth. So you can look at it this way. See, they've increased shares less than 1%, and revenue has grown 2.79%. So you'd like to see that much higher if they're going to be issuing shares. The earnings per share has grown 23% over the last 5 years. Dividends, very healthy increase over the last 5 years of 25%. The current dividend free cash flow ratio, like most utility companies, the free cash flow is negative, which that can't go on forever. We'll have more on that in a minute, but do know that the current dividend free cash flow ratio is negative 94%. And the negative free cash flow per share is negative 37% those last 5 years. Pinnacle West dividend yield, a very, very high 4.99% for a utility company. The annual payout, $3.32 a year. So you see the 5-year growth rate is 5.84%, but we had a much higher number. So when I got that number, I didn't do the compound annual growth rate. I just took the raw number of what they paid out in dividends from 2016 and then from 2020, and that was the difference, was about 25%. That dividend has been growing for almost 10 years, paid out quarterly of 83 cents. So Arizona's population, I know a few people that have moved there. It just keeps increasing and growing. And that dividend has been increasing nicely over the last 9 years. But energy efficiency regulations are something that politicians love to talk about and push. So that's something that could have an effect on companies like Pinnacle West. And solar panels are definitely an issue as more people try to switch to green energy and renewable energy. Solar panels are going to cut into Pinnacle West's business. Also, rising interest rates could be a negative for companies like Pinnacle West because as interest rates rise, that could push investors from utilities back into bonds. And as they flood out of the utilities, then the share price could precipitously drop. So, what's my opinion on Pinnacle West? Well, like most utility companies, they almost all have negative free cash flows, and this just can't go on forever. I know it's been the trend and the pattern for the last 5, 6, 7 years with the utilities, but this has got to change. So it is a little bit worrisome, and I'm going to keep an eye on the net earnings and their revenue. If those start to turn down, especially that revenue, which has only grown by 2% over the last 5 years. If that starts to drop, then baby, I think it might be time to turn and burn because they're just going to have to issue more shares and go further into debt to pay those dividends to look attractive to investors. So Pinnacle West, that's 2 for 2. I'm not investing in Pinnacle West because I already invest in companies that I like a little bit better, like Duke Energy and Consolidated Edison.
Oh, yeah!
Verizon, we got ticker VZ up here. That's our third 52-week low company. Verizon Communications, 52-week high, 61.95, and a 52-week low of 53.22, which they did just a hit. They are down 9.53% year to date, and they have a big old massive market cap of $220.42 billion. So what's up with Verizon? Check it out. Their revenue only up 1.84% the last 5 years. Their net earnings 35.61% up over the last 5 years, which is good. Because remember that the net earnings are how much revenue does exceed those expenses. Check out the retained earnings up 301%. That is out of this world. And long-term debt, most companies' debt is so cheap. Almost all these companies are going to take on some debt. Interest coverage ratio could be a little bit better, but I'm satisfied with it being over 5, $7.57. Of operating income to cover every $1 of interest expense. They've increased your equity in Verizon 188% since 2016, which that looks really good. Solid number. Share dilution, 1.37%. They consistently put out more shares every year, so that's not crazy, but I'd like to see that buying back. So Verizon doesn't buy back shares. Earnings per share, though, has increased 33.9%. So yes, they are putting out more shares, but they're still increasing that earnings per share. So that is good to see. The dividends have increased. Remember, this is how much they paid out in dividends. 8.73%, so they're growing the dividends. Current dividend free cash flow payout ratio, only 48%, so that's under 50%. That's really nice and healthy. Now, their free cash flow has grown 418%. That looks phenomenal. But here's the bad thing. The trailing 12 months, they are down $5.80 of free cash flow per share. But I suspect a lot of this has to do with this news article. When back in February of 2021, they pledged more than $45 billion on the 5G spectrum. So they've got a good chunk of change that they're trying to move forward and grow the company with. I like to see that they're spending money. They got away from AOL and Yahoo and other things that they had no business being involved in. Who the hell even knew AOL was still around anyway? Current dividend yield, 4.81%, paying out $2.56 annually. The 5-year growth rate, though, that's the 5-year compound annual growth rate, only 2.11%. So when you compound that, doesn't look as good. And they've been growing that dividend for 8 years. And they pay that dividend out quarterly at 64 cents. So they have the broadest coverage in the industry. They have the largest U.S. customer base, and they're expanding their fiber optic and 5G technology. So competition like T-Mobile will be deploying their new spectrum and cheaper wireless technology to increase their own coverage. And that increasing debt could be an issue, and it's eventually going to have to be addressed and started to be paid down. I'd really like to see their revenue picking up into the double digits. That trailing 12-month free cash flow of negative $5 a share is pretty worrisome, but I think a lot of that has to do with the over $45 billion that they committed to and that they bid on in that the 5G spectrum. So I'm still buying Verizon, and I just bought a little more Verizon this week because I think that they are committed to trying to grow the company, and it may look like a slight step backward, but they are investing in their own future. So what company feeds 1% of the world's population every single day? It's McDonald's. McDonald's, ticker MCD, you knew that. It's McDonald's. And if you'd like to know more about McDonald's, now with 7% more McDividends, click the video right here. Let me know what you think of this. I'd love your input if it was too lengthy, too many numbers, and I will see you in that McD's video.